All right, so we are live here with a good friend of mine, Roger Vincent. I've been learning a lot from him. I've gotten to know him for the last couple of years. We met through the LP community. Just a wealth of knowledge from this individual here. So, Roger, welcome to the show. Excited to kind of learn about everything that you've done in the last couple years. Just with your career at the institutional investment firm and kind of with all the exciting things that you're doing in the private market. So, welcome to the show.
Joel, thanks for having me. It's great to be here. And you already know this, but I love all things private equity, and I love talking about it and love sharing the insights that I've picked up along the way. So I'm excited for whatever you want to talk about.
Yeah, well, let's jump right into it. For those that are new to getting to know you, maybe you can start with just your early career, because some people are looking to break into becoming an LP. We see fund managers later in their career that become LPs. I've seen LPs that have become fund managers. So for the audience, this is, a huge treat for them because there's a lot to unpack here. So Roger Vincent spent some time at Cornell, and now he's running Summation Capital. So maybe just talk about your journey of like where you studied, kind of your education, and how you got into the LP space, and tell us what you're working on now.
Happy to do that, but I've got to go back a ways. So I came out of Dartmouth in the mid '90s. So I'm coming up on about 30 years in the investment world, and specifically in private equity. I started my career at DLJ, which got bought by Credit Suisse, so the name's not around anymore. But if you're of a certain age, the DLJ name typically resonates with people. It was a wonderful firm, and it had a couple of things that it probably did better than any investment firm or any bank on Wall Street. One of those areas was private equity investing. And back in the day, a lot of private equity firms were called merchant banks, and DLJ had two vehicles. It had the DLJ Merchant Banking Group, which focused on what at the time were large cap buyouts, and then it had a sister fund, which was called the Sprout Group. And it was a well-known, I'll say famous, venture capital firm dating all the way back to the 1960s. I ended up doing stints at both those two different arms. So I had experience as a young GP in both the buyout world and the venture growth world in the mid to late 90s. And so I really got very lucky early in my career, ending up at a place or starting at a place that was as good as DLJ was, with so many great people, and specifically getting to start my career in the private equity industry. And it really gave me, from a very early start, what I would call an ownership mentality and a long-term thinking view of the world. So from day one, I started thinking, as investments as being, 5-year hold periods on average. When you're early in your career, 5 years feels like all the time in the world. Where I am now, it feels like the blink of an eye for an investment. But I got to start doing this early, and I got to start doing it under the tutelage of people who went on to form or build a bunch of very notable private equity firms. And that's where I got my start. I stayed at DLJ in those two different organizations till about 2002. At that point, we were through the dot-com bust. Credit Suisse had bought DLJ, and they were de-emphasizing private equity investing. And so I took the opportunity to go get my M.B.A., and then I joined a lower middle market buyout fund. And I continued to cut my teeth as a private equity deal investor. And I ultimately made partner and began building my own track record and leading deals. And then around 2011, 2012, I pivoted. And I started what I call chapter 2 of my career, and that was the switch to the LP side. And I'll pause here in case you want to interject with any questions, but that's a little bit of an unusual move. There are a handful of people in the allocator world that have, heritage as GPs, but I think it's a little bit more common to go the other direction. The LPs want to become GPs, and it's a little bit less common. But it's incredibly helpful to have that experience, or it was incredibly helpful for me to know what the insides of a private equity firm, and not just one, but 3 very different ones, what they look like, how they operate, what a good transaction looks like, when you're underwriting a fund, to be able to go deep with them on the weeds of executing a deal puts you in a really nice position to have a very candid conversation and start to understand them more deeply than you would if you didn't have that experience.
Sure. So I would say it would be really interesting to learn about what were the skills that you developed. Maybe we can break it out into the hard skills and then the soft skills, like specifically on the hard skills. What are some of the financial models that really helped you, evaluate the companies? Because definitely, progressing to the partner level is not an easy feat. So maybe sharing, some of those skills in terms of how you progressed as, as a fund manager on the private equity side. And then, maybe we can get into the LP side as well.
Well, so DLJ was famous back in the 90s for its hard work ethic and its quantitative approach to things. So I got a very, very good training in financial modeling, in putting in the hours that were needed to get things done right. I think those are all very important tools to have to be successful as either a GP or as an LP. Mm-hmm. If you don't know how to model a business on a go-forward basis, then you don't really understand, all components of its financial picture. But that's a model only gets you so far. And there's a lot of great sayings about, models. The one thing you know about a model is it'll never be right. And so, people don't, believe the models, per se, but they're wonderful exercises in making sure that you really understand, what the companies are doing, so you can put the input. So it's a very good exercise in making sure that you understand the underlying portfolio companies or a company you're targeting. For instance, as you model something, you're going to have to make some assumptions about margins going forward. Well, as soon as you try and have a backed up answer for that, you've got to start to understand, what the competitive position of a company looks like. Is it going to have pricing power? Is it going to have cost pressures? And so the model really forces you or should force you to understand the company. But that's a step that I think you've got to proactively take, and you've got to do the extra work to do that, because you can plug in bad numbers and garbage in is garbage out, as they say in a model. And I think, switching from the LBO side of the business to the venture side of the business really helped me develop that skill as well. When you're doing a venture investing, the margins don't really come into it.
Sure.
Either the product's going to be or the service is going to be a huge success, and things are going to take care of themselves, or they aren't. So you start developing an ability or some muscle analyzing some core business fundamentals, understanding customer demand and things like that. And those were two great but very different skills I pulled out of my two different experiences, both the buyout side and the venture side. But if I had to wrap it all up into one thing that I would say, hey, look, I'm always looking for I'm always looking for alignment and cohesion. And that'll be something I'll repeat later on, I'm sure, when we're talking about investing as an LP. But the deals I was a part of that really worked the best, everybody was well aligned. The management team had the right incentive package in place. They were going to make money if we made money. The customers were going to do well. The employees were going to do well. I mean, every direction you looked in, it was kind of, it was a fair deal. And the sellers, were going to do okay. And more importantly, the people you were going to sell the company to were going to do okay. It's no good. Let's say we're talking about a venture investment to, have a great venture investment, but then you sell it to the public markets, mm-hmm. and the stock tanks on them. I mean, that's, maybe you got your money out, but it's not a repeatable business.
Sure.
And the further on I found I got in my career, the more I started thinking about the fact that, you can, I forget the exact way the saying goes, but you can want to shear a sheep multiple times. So you want to find a business model that works, that can be repetitive, and everybody's got to do well. Everybody who's helping to make it be successful has got to do well for it to be a repetitive way to make money.
So when we think about software, a lot of times you can build one time and sell 100 times, right? That's the beauty of SaaS. What were some of the industries that you preferred or really appreciated working on, especially when you took them to investment committee? Was there a certain industry that you're focused on, or were you guys pretty agnostic when you were kind of evaluating on the GP side, looking at PE deals?
Yeah, I ended up, it wasn't by design, but I ended up really just being a generalist when it came to sector. And that cut both ways. On the one hand, I enjoyed it because I liked getting to see different sectors and be a part of them. On the other hand, I think as the private equity industry matured over the time that I was in it, the need to specialize continued to grow. And when I started in the private equity industry, I think a decent estimate about the number of GPs in the world would be a couple of hundred. And there were probably a few dozen that were brand name that mattered in some sense. And today it's probably 8,000, maybe it's 10,000. Right. So as competition has increased in the number of managers, people have had to find ever more narrow niches within which to specialize. And you can specialize in a bunch of ways. You can be the biggest on the block, and so a bunch of people strive to raise the biggest funds and be unique in that way. But in the middle market and many of the markets of private equity, the way a lot of people have specialized is based on sector. And so I felt to be successful as a GP going forward in the middle market buyout segment, which was where I was in my last GP seat, that there was going to be a need to really get more focused and be more specialized. And that was part of my choice to move to the LP side of the table. What I found, Joel, was that I had this somewhat eclectic set of experiences, but the one thing common was they were all private equity experiences. So I was a specialist, but I was a private equity specialist, not a buyout healthcare specialist.
Sure.
So I decided to take that specialization to a level in the ecosystem where that specialization really mattered, and that was at the LP level, where I could come into an endowment and be very knowledgeable in the private equity asset class. And so I decided I wanted to take my career in that direction and be a private equity specialist, but more of a generalist across the industry, where I could invest or think about investing across geographies, across segments of the market, and across sectors. And that's what being an LP sort of opened up for me in my career.
What are some of the things that you've seen evolve in terms of the multiples? So as a generalist, obviously there's different expectations for multiples based on EBITDA. So, have you seen kind of the multiples, for example, in software kind of increase from, maybe a decade ago? So maybe some trends in certain industries, maybe it's essential services, healthcare, software. Maybe you can unpack some of the other niches that you looked at, and maybe the multiples, and then kind of the evolution of what you've seen in the last few years.
Yeah, we used to have a joke that the other name for the private equity industry, and I guess I'm thinking about buyouts now, was we call it multiplying by 6. It felt like that was about as sophisticated as the math ever got. We would build these 100-page models, but at the end of the day, what was the value of the business? Well, let's just put a 6x multiple on it.
Sure.
And many times it wasn't more sophisticated than that. I will tell you, from the beginning of my career till today, typically we were trying to underwrite deals to a 2 to 3x net return. A little bit higher if we were more on the venture side of the industry. Maybe we were a 3 to a 10x return at a deal level, but with a higher loss ratio. And that, that's changed in some segments of the market, but in the core segments of the market that, I continue to invest in, meaning not the very mega cap funds, I think most managers are still underwriting, at a fund level to put up, a 2+X net fund. So the return expectations of the industry haven't really changed, but how people get there has changed dramatically. So instead of, buying something at 6 times, assuming you were going to sell it at 6 times, amortizing your entire debt package over a 5-year period, there's now different ways to do it. And the much more common deal is you buy a higher quality business with better margins, more recurring revenue, but you're going to pay 10 times. And part of that's enabled by lower interest rates than when I started my career, even today. And you're maybe going to lever it a little bit differently. You're not going to pay down all the leverage over that time. Maybe you'll recap it halfway through. And you're going to put a lot more attention on value creation and hope that you can sell it at a stepped up multiple, either because you've significantly grown the company or because you've put it in a better competitive position, or it's evolved into a better competitive position, and you can sell out to a strategic. So there are a lot of ways to skin that cat. But definitely, one of the big eye-popping things over the time I've been in the industry was, deals that were being bought at 6x, time in and time out, maybe a little bit higher than that, are now routinely better competitive positions. And but they're also better companies. Mm-hmm. A recurring revenue software company deserves a much better multiple than the more basic metal betting stuff that was more common when I started.
Sure. What are some learnings that you would pass on to the next generation of LPs? So there's, definitely LPs that are listening in today. So maybe you can share some wisdom with people that are building their career and, starting to allocate to new managers as well.
Yeah, well, I mean, where to start, where to stop? We could do this one all day long. So, we just, I think, got to the point where I was, leaving the GP world and going into the LP world. And my first piece of advice is, if you're going to be an allocator, it's incredibly helpful if you can build some knowledge from the GP side of the table. You see this all over the place. Back in the day, back when I was doing venture capital, most venture capitalists were former finance people. But the industry's really moved against that. Now, most venture capitalists are former entrepreneurs. And why? Well, you're partnering with entrepreneurs. It's really helpful if you've been in their seat and you can empathize with them. You know what they're going through. You know what their challenges are. You maybe know what skill sets they're going to need to have. So in anything one wants to do in life, if you can spend some time on the other side of the table first, I think it's going to give you a huge leg up. So anybody that wants to be an allocator, that's a good idea. But let's say you have or you haven't gotten that prior experience, and now you find yourself allocating. I guess the first place I'd start is most people want to talk about manager selection and how to select a good manager. I'm sure we'll get there in this conversation. But I want to say, when you're running a portfolio like the one I ran at Cornell, and maybe I should just mention to the audience. So I moved from the GP side to run the private equity portfolio at Cornell's Endowment. And I ran that for about 12 years before leaving to start Summation earlier this year. When you're running a portfolio like that, manager selection is important, but so are other things. And portfolio construction is really important. And vintage year diversification is really important. And managing unfunded liabilities is really important. So before you just jump into the sort of the more fun part of, who do you like, who's a good manager, make sure you understand the framework that those decisions are going to be slotted into, because they're not the first decisions that you need to make. You need to make portfolio construction. And a key part of portfolio construction is how many managers are you going to have. And if I were asked to build a portfolio, first off, you want to know what you're optimizing for. So the first question is, okay, well, what are we optimizing for? And there's generally two things that you can optimize for. One is potential return, and the other is expected return. And most long-term asset owners, like an endowment, are optimizing for expected return. And so that is, look, we want to have a very good shot at achieving, let's say, a 2x multiple of our money, and we want to really take off the table the lower band because we're risk averse. We understand that to cut off the left tail, we'll mitigate, we'll take off some of the right tail. But that's not how everybody operates. Some people, are at some level of wealth and they want to get to a different, quantum of it.
Sure.
And you're not going to get there, by, diligently managing a diversified portfolio. So you may want to take on more tracking error. The ultimate expression of that is you don't do tons of funds. You do one fund, but if you want to really get tracking error, you don't do one fund, you do a single deal. The ultimate, tracking error investors are the entrepreneurs of the world. And when it works, and they end up becoming the wealthiest people in the world, a la, Bill Gates and Jeff Bezos and, Elon. But if it doesn't work, they become somebody that you've never heard of. And so what do you want to do? You want to shoot the lights out, or do you want to get the best expected return you can? Like I said, my experience at an endowment is all about trying to design really well diversified portfolios with high expected returns. So once you define what you're looking for, you then want to think about how are you going to construct your portfolio. And one of the most important criteria is, how much diversification can you have on a couple of different metrics? How many manager relationships can you have?
Mm-hmm.
If you can only have one, and you've already decided that it being diversified is really important, well, you're probably going with a generalist who's, global and a mega cap investor. You can't be a generalist across multiple sectors unless you're large. You can't be across multiple geographies unless you're large. I mean, you just couldn't possibly invest in all those different places. And so who you invest in, who's the right choice for you, you really have to start with what you're trying to achieve. And so how many managers you can have is a good starting point for that. So it's a complex question because it depends.
Yeah. No, that's interesting to think through that. So you want to be diversified in your LP portfolio construction. And then do you prefer all the managers to also be diverse, or do you think it's okay for some of the managers to have a high conviction concentrated portfolio at the GP level?
So almost that. So what I like to do is have diversification at the allocator level,
mm-hmm.
and then let the specialization or the concentration happen at the GP level.
Yeah.
Now, you don't want your GP to take so much concentrated risk that if there's an externality and they have negative outcomes, that it creates sort of existential problems for them.
Yeah.
All right. One of the problems you can have when you invest with a GP, I mean, you want them to go on and be successful, right? If they're not successful, they may build your portfolio and then the whole team may move on because the firm's not being successful. And now you don't have the people who are supposed to be managing your investments actually managing your investments. So you want to invest with GPs that you think have staying power. And even if you're a great GP, you've got to understand, any investor should understand that the world is probabilistic. And a great GP making great decisions, doing hard work all the time can have bad funds and bad deals. Yeah. It can just happen. And so you've got to build your diversification to take that into account. But you also have to make sure that they're not taking so much tracking error risk that a bad market situation could put the whole firm at risk. And so, let's say you were investing in somebody that was doing hospitality. And let's say they wanted to be super concentrated and really believe in everything they did, and they were going to do a deal, a fund with 4 deals in it, something really small. And let's say COVID came around. What's the chance that GP is ever going to raise another fund? It's pretty slim. So we want to think about it at that level, but ideally we're doing most of the diversification at the allocator level, and then we're picking managers that are more specialized. And it should come as no surprise that you would expect a specialist to have higher returns in their area. Mm-hmm. And I think that, it's a military saying, but, you want to put decisions down as far as possible. You want to get as close to the coal face as possible. So we want people that, are U.S. focused. Maybe they're in a certain cap size. They're focused on a sector, and within that sector, they're focused on a specific type of deal. Well, no surprise, all else being equal, we think that investor is going to outperform the generalist who dabbles in that segment from time to time. Mm-hmm. But that specialist is also going to, face a lot more exposure to anything that hits that specialty area, like we just talked about before. So a really nice portfolio construction is to create a lot of diversification with a lot of specialty managers.
Sure.
So you get the benefit of the specialist outperformance, but you get the diversification by having a lot of specialists. But that's resource intensive. Mm-hmm. And so then it comes back to how many resources can you throw at the problem? How much money? What can your average check size be? Is that check size relevant to the type of GPs that you want to get into? Do you have enough people on your team to underwrite that many managers? And can you really track what they're doing? Sure. I would say I love diversification, but not at the expense of not knowing what the managers are up to. Mm-hmm. If you can't really dig in and know what they're doing, you can't tell whether they had good process with bad outcomes or bad process with bad outcomes. And it's really important to be what I call a windshield, investor as opposed to a rear view mirror investor. It's really important that you can underwrite expected returns. And, we have great, I've had great manager relationships where they've had some bad deals in their history. And in fact, how do you learn and how do you go through life unless you've had some bad deals? And so you've got to, as an underwriter, you've got to be able to look through those bad deals and understand whether it was a good investment to make, but it didn't work out, or it was a bad investment to make, but they learned the right lessons.
They learned something, yeah.
Those are all great things. One of the managers I least liked we didn't invest with them obviously, but they spent a lot of time in the meeting bragging about how they had never had a deal lose money, and they've been around for a while. And so it was actually pretty impressive that they had gone that far and never lost money on a single deal. But lo and behold, a few years later, I was at one of the New York City hotels attending an annual meeting, and they were having their annual meeting in the conference, in the big ballroom across the hallway. And I poked my head in, and they were given a mea culpa for a couple of zeros that they had.
Oh, wow.
So you're going to lose money at some point.
Yeah.
And if it's never happened to you before, it maybe arguably increases the risk of the investors coming in and investing with you go forward, because maybe you're a little bit less sensitive to some lessons and you have a little less scar tissue, and that scar tissue is really important.
Yeah, and it's just statistically probably impossible to not have any losses, right? I mean, in reality, over time, it's just, if you just do a lot of statistical analysis, right? I mean, there's just no way you can have no losses, I would say, just probably by looking at the data. So sometimes I might even just raise an eyebrow and say, wait a minute, it might be almost like a yellow or red flag if people are bragging that they haven't had a loss.
And not going to that extreme. I mean, if you throw 10,000 GPs randomly at the market, there could be GPs with great track records. But if you start with the premise that it was, it's like monkeys at the typewriter, if it was all random, you are going to have great ones. So if all you can do is underwrite historic returns, you're going to end up with the ones that have historically great track records, but it might not mean anything.
Sure. Yeah, no, absolutely. Well, that goes into my next question. So what are some of the, we talked about, I think we're alluding to integrity, alluding to just kind of humbling yourself, but what are some of the personality traits that you like to look at when it comes to managers? Because this is a long-term, multi-decade game. And then what are some of the, you talked about the specialist funds. What are some of the specialty industries that you're excited in right now, being 2024 fall?
Yeah. So I would say on the soft side, I said I would come back to this, but alignment is the number one thing that we look for. Is the GP aligned with us, the LP? And I think you've got to go so much deeper than what is their GP commit. I mean, that's such a cartoonish way of looking at alignment, but it seems to have taken over the industry as, let's just use that as shorthand for, whether they're aligned or not. And I can't define, every component of alignment, but you got to go in there and really look at whether that alignment exists. But then you better look at, is the GP aligned with their portfolio companies? Are the portfolio companies aligned with their customers and their employees? And the more that you find alignment, the more confidence I have. And if you find lots of great alignment, but then all of a sudden in one sector there's no alignment at all, it really is a worry, because then you sort of think, okay, well, maybe this is a learned habit and not, something that's innate. I mean, maybe take a GP and they've got great alignment. They're putting lots of money into their GP. They're doing other things that if you convince that they're well aligned with the LPs. But what if they churn out their analysts, after 2 years, and they bring them in and they promise them at the partnership or the mid-level people that they're going to transition to senior leadership, and then time after time after time they don't do it. Okay, fine, they're a good partner to us, the LP, but are they good partners? I would say no. In my book, if you're good partners, you're going to be good partners on a 360-degree basis. You're not going to be good partners only in one direction. So we look for that. You'll have to remind me exactly what the question was. I think I had a second point that I wanted to make on that before we go into specialties. But I guess maybe the second point is, and this has changed over the time I've been in the industry, but you find a lot more personable people in private equity than you used to. Back in the day, the PE industry, the buyout industry in particular, but also venture was known for a lot more sharp elbows.
Yeah, and hostile takeovers.
Yeah, hostile takeovers, and a stereotypical sort of Wall Street mentality.
Yeah.
The other way to look at the industry is, not that you have all the money and he who has the gold makes the rules, but you're selling your firm and your firm's capital. And guess what? It's the highest priced capital in the entire capital markets ecosystem. Mm-hmm. All right. There is no other source of capital that is more expensive than venture capital or growth equity or buyout. And so if you sort of shift how you're looking at things, you're now, as the GP, you're selling yourself to these companies that are taking your money. And, sometimes the person that can sell the best is going to win that. And so you do find that people in the private equity industry are very good salespeople, both towards LPs and towards the portfolio companies. But oftentimes the management company in a leveraged buyout has the choice of who they want to work with. And certainly the entrepreneurs oftentimes have a choice of who they're going to take venture capital money from. So it turns out that good people make good private equity investors. And the reason for that is people want to work with other good people that are going to be good partners for them. So look for good alignment, and then look for people that you would want to have a long-term personal relationship with. If you're a good and reasonable person and you want to have a good long-term relationship with this GP, you think they're being sincere and they're not just doing that to you because you're the money to them, but that's just how they treat people, they're probably going to be a pretty good GP, because other people in other sectors, their employees are going to work with them, their portfolio companies are going to work with them. So it's a nice industry in that what you want to do, the good people you want to work with are actually also turn out to be the ones that are going to do the best for you, in my estimation.
Yeah, and I would say in your evaluation, kind of looking at their culture building, their team building, it would be a concern too if the culture is a little more cutthroat, where like the GP is promising a leadership path to the analyst. There's a lot of churn because you need to have those people skills and those culture building skills. If you really want to get to like a fun 3, right? You need people that are kind of there for the long haul to kind of evolve with you. That way you can showcase that they've been with you for a long time too. So I'm assuming that's probably a yellow or red flag if there's definitely a lot of churn. And then, to your point, right, you're talking to the analyst that left and they're kind of complaining about, broken promises and all that. Because if they're breaking promises to their employees, they may be breaking promises to the LPs.
That's right.
Right.
That's right.
Mm-hmm.
So,
I've been answering a couple questions to some GPs, kind of giving, bouncing ideas off of them. Some of them have been looking at GP stakes investors, and some of the terms seem favorable. Some of them could be a little more predatory. So just maybe your thoughts on, just in your career, just kind of the GP stakes investor. I think, look, in my opinion, sometimes it's a little more expensive for that capital. However, if that capital is going to help you get over the line and, really anchor your first fund, sometimes you have to give up some of those GP stakes or a percentage of those GP points in exchange for that, right? So any just high level opinions on the GP stake side and the pros and cons, and then also just kind of the manager side of taking it or not taking it.
Well, I've looked at funds that do GP stakes. So I've looked at those funds as an investor. I mean, GP stakes is just about the most complex area in terms of figuring out alignments. Yeah. And I haven't invested in any GP stake funds. I just don't know that their expected returns are going to reach our thresholds that we were setting for expected returns. But it's an open question. And, I think the problem is that, it's unclear. It's still unclear what the terminal value is on those stakes. Mm-hmm. If you're a young manager and you're trying to build your business and you have a choice between, selling a stake in your GP and not selling a stake in your GP, I think it's not a bad thing to do. I mean, getting into this business, if it's what you love doing, and you shouldn't do it unless you love it, you should be willing to give up some of that. And in some respects, some of the misalignment the worst misalignment I've seen in the industry is the GPs that aren't going to get rich by making the LPs money. They're going to get rich by monetizing their GP, ownership. And that's a little bit galling as an LP because, they're building that off the back of, the money that we've given them to put up, do funds. But they're benefiting from that all by themselves. And, that's a good example of why you can't always trust the GP commitment to tell you the full story on whether there's alignment. Sure. That GP commitment, sure, it's getting the same return that you're getting. And that's what they talk to you about alignment. But it's also getting them something that you're not getting. It's helping them raise that fund, and raising that fund is helping them build the value in the GP, and they're getting that all by themselves. And so they're not fully aligned with you just because they're putting money into the fund, and it has to come back to that GP stake. So I think, this is a segment of the market that will continue to grow, and it will probably become more the norm that people start giving up a piece of their GP, early on in their track, early on, and not waiting till, they've done 6 or 7 funds and then, deciding they want to, take some money off the table and then doing a few more funds and then figuring out how to sell the GP to the next generation. But that's been a big trend. When I started, nobody contemplated that the GP was worth anything.
Sure.
And it wasn't supposed to be worth anything. The whole deal was, the management fee was going to keep the lights on.
Yeah.
And so this all evolved only because as funds grew and the management fees became more than keeping the lights on, that the management fee didn't change, right? Now, what would have been fair and what would have stuck to the original bargain of the original funds that raised money on a 2 and 20 structure is once the assets grew large enough that 2% management fee was more than you needed, that the 2% should have come down. And to their credit, there are firms out there that have taken that approach. But if you don't take that approach, then excess cash flow builds up, and it's that excess cash flow stream that creates value at the GP, or really the Manco more than the GP. Yeah. And so that's why this has all evolved over the time horizon is those excess cash flows have created value at the Mancos, and now everybody started thinking about, okay, well, now that's an asset. How do I monetize that asset? But if I had my preference, the industry would have gone the other direction. They would have said, okay, it's 2% until some level, and then once we get up to that level, it's not 1.75. It's, let's go down more dramatically and make sure it really is, just what we need to run the business, and there's not excess, fees above and beyond that.
Sure, that's helpful. And then going back to the previous question, which I don't think we got to because I probably cut you off with another question. But the question was the specialty industries that you're excited about. Wanted to double click on that for a second.
Yeah, I'm gonna answer with a non-answer. I'm gonna say, look, I mentioned before that I really think if you want to get the best, potential returns in an area, you got to go with a specialist. Yeah. But you've got to balance that with your need for diversification. Yeah. And there's a lot of data, I think enough data to back that up that, specialty funds outperform non-specialty funds. But what I want to say is, look, being a specialist fund is most typically thought of as being a sector specialist. But that's not the only way to think about it. And that's one of the things that I liked in what we built at the Cornell Endowment was we got much more creative about what it meant to be a specialist. And unless we were prioritizing somebody bringing diversification to the table in a market where maybe we felt we needed to get more diversification rather than more specialty focus, leaving that aside, when we look for specialists, we were very open-minded about what that could mean. And sure, it could mean a sector specialist, but it could also mean that you're a specialist doing a certain type of deal. And that can cut across sectors. And so let's say your specialty is buying companies from families. Well, families, sell businesses in ways that are unique. And being able to work with them and deal with those uniquenesses however they present themselves, is a skill, and it's something that you can be better at or worse at, and that's a way you can specialize. It's just one of many. I mean, there's almost a number of ways you can say I'm going to be a specialist. So on that topic, I'd prefer, rather than picking one or two industries that I happen to like, I would just say, look, think about the question more holistically. And I'll say I like specialists, but I like specialists in any way that they can make a strong claim to that specialty, really helping them, execute deals that are going to be better than someone who's not a specialist doing it.
Yeah, that's a good point. And it might also kind of merge into a strategy, right? So, I mean, your strategy could be your specialty. And I've seen specialties kind of go maybe 2 layers deeper in specialties. So like when you think about AI, I've seen a fund focus specifically on AI co-pilots. And like that's kind of their next strategy for the next 7 years. And then I've seen AI focus on infrastructure and development tools. So I think whatever that specialty is, if you're the one that's going to kind of get those repeatable, hopefully outsized returns, and I think that works, right?
Yeah.
And I think no matter what the specialty is, there was another fund that I saw that was really interesting. They invest in paveways. So like, when you think about the roadway system, like the stripes that are on the road, that's something that you can't really replace with a robot, right? Because you still have to have those relationships with those governments and kind of those entities, which is really kind of a relationship business. So that's kind of their specialty, because it's hard to get someone to kind of just jump in that market immediately.
That's right. You could specialize in selling to those municipalities. You could sell them the strips, and maybe you rent them the traffic cones, and maybe you lease them those giant metal iron plates that sit across, the potholes and manholes in New York City. I mean, you could make an entire fund. And in fact, I could think of one that really specializes in selling into that market. And guess what? If you know the head of the transportation department, well, and you know what their pain points are, I bet you could do that a lot better than a generalist who, once in a while sees a deal in that area.
Yeah. Well, Roger, this was amazing. I know we could continue going on. I have a lot of stuff that I want to continue unpacking, but I know we're at time. So I want to ask one final question. It's really a piece of advice that you have for emerging managers that are out to market. They're trying to kind of get to their first close or even their final close. What advice would you give people that are kind of really trying to build an LP pipeline and build trust with LPs to kind of get to their first close, get them over the line?
Wow, that's a tough question, especially in today's fundraising market. I know a lot of GPs who fit that description that would love to have a good answer, and I'm afraid I don't have any particularly good answer to share.
Yeah.
I suppose be patient. The pig will get through the python. And so what's happening now is we're still feeling the effects of the denominator effect of 2022.
Yeah.
And you would think that once public markets had reached recouped their losses and we're back at their highs, that the denominator effect would kind of go away. And so markets fell for almost all of 22, but they recouped themselves within a year. And but that's not what happens. And the analogy I like, if you've ever thought about or studied traffic patterns in a heavily trafficked highway, if one person slams on their brakes, let's say they're looking to change the radio station, and they kind of something happens, they slam on their brakes, the traffic will back up at that point for an hour, maybe longer. Sure. It's like a standing wave. And so the original car stops for a second, and then they move on. But then every car behind them, has to come to a stop in that place because of their accident. And so that's the same effect that's being propagated in the markets. A sudden stop happened when interest rates went up in early 2022, and everybody got denominator, or many people got denominator. And now it's going to take a long time for that to work through, and it may take another year. There's starting to be green shoots. So, if you're an emerging GP and you can be patient, if you can make the business work on a smaller amount, get that first fund done, eventually purse strings will loosen up. That's about the best advice I can give. That wouldn't be obvious to people, but go out and build strong relationships with people and develop a reputation for being somebody who does, exceeds the expectations that you set. And I think that's the only, true north that you can align on. Everything else is tactics.
Yeah. Well, Roger, this was amazing.
Okay.
As always, learn a lot and appreciate you sharing all your wisdom and your time with the community. Really appreciate it.
Joel, thanks for having me. It's been a lot of fun.
Absolutely. Okay. It was a lot of fun. Take care.
Take care.
Bye, guys.